Knowing how to manage your finances is an important skill to have. Whether you're trying to save for retirement or pay off debt, being able to answer the right questions can make all the difference in your financial life. If you think you're great with money, take a few moments to answer these questions and find out how much of an expert you truly are. Hello, my name is Lulu, and in this video, I will have some interesting questions for you to answer. Please don't forget to like, share, and subscribe to this channel. Money doesn't come easy, and it's important to understand the basics of money management. Knowing how to answer these questions can give you an advantage in terms of managing your finances and making sure that you are utilizing your money wisely. We will look at the use cases of each question, how it can help you in financial planning, and what steps you can take to ensure that your finances are managed properly. 1. What is a deposit? A deposit is the first step in putting money into an account. This typically involves depositing cash into a bank or credit union. Deposits are the first step in saving money, and often people initiate this by using cash to make sure that they can't spend it once they get it. Deposits are also used when someone wants to buy something from an individual or business, such as a car or house, so they can put money down as a deposit. 2. How does a deposit work? A deposit typically involves handing over some cash, such as coins or bills, to the business or individual to hold in their account. The amount of the deposit is typically marked on the receipt given back by the customer/business. The customer/business will hold on to this money while it works for them and will pay out any profits on that money back to the person who deposited it, usually when they are ready to buy something from that company again. 3. What is a savings account? A savings account is an interest-bearing account that's not attached to any type of loan and usually earns a fixed or variable rate of interest. These accounts can be held with banks, credit unions, or savings and loan associations. Although it is a savings account, people typically use these to make smaller purchases as they need them instead of using a debit card or credit card. Savings accounts are also used to save money for a specific purchase or goal, such as retirement. 4. What is the difference between a savings account and a checking account? With a savings account, you can't spend more than what's in your account. A checking account is linked to your line of credit, credit card, business loan, etc., and allows you to withdraw funds from it when needed for daily transactions. A savings account is a bank account in that you can't spend more than the money deposited into it. A checking account is an account with a line of credit that allows you to withdraw funds from it when needed for daily transactions. 5. What is a checking account? A checking account typically pays out less interest than savings accounts and is connected to an ATM card that allows for rapid fund withdrawal. These accounts are usually used by people who have access to one form of payment, but not another, such as someone with limited access to cash. They are also often used by businesses looking to get quick access to funds. 6. What is a credit card? A credit card allows you to charge funds against a line of credit provided by the card issuer. You are responsible for paying off your balance each month, as well as any interest and fees incurred during that month. If you fail to pay back your balance in full each month, the lender may revoke your card with little warning or contact from them. 7. What is an automobile loan? An automobile loan typically refers to a loan made or secured by the use of an automobile as collateral, i.e., using your car's title/registration/VIN to secure the loan. The automobile may or may not be the borrower's personal car. 8. What is a credit union? A credit union is similar to a bank, but it's managed by the people who use it, unlike a bank, which is an all-powerful company with no connection to the people who use it. Credit unions are usually easier for someone with a limited or fixed income to open up an account. Credit unions are often more transparent and have lower fees than banks because they don't make as much money off of customers as big corporations do. A credit union is a financial institution that is owned and run by its members, not by an outsider. Credit unions are owned and governed by their members, which usually include people who are part of the same organization or group. They typically have lower fees than banks and often more transparency and local representation. 9. What is a credit rating? Credit ratings are an opinion on how trustworthy a borrower is to repay what they borrow. Credit ratings are also used by many institutions to determine the risk of lending to someone. Credit ratings are opinions of how trustworthy an individual or company might be in borrowing money or repaying debt. 10. What is the difference between a credit rating and a credit score? Credit ratings are opinions of how trustworthy an individual or company might be in borrowing money or repaying debt. Credit scores use numerical data based on information provided by your creditors to calculate the likelihood of you paying back what you borrow. 11. When does the maturity date on a loan factor into the payment? The maturity date is when the loan will be paid back. For example, if you borrow $5,000 for 10 years at a rate of 4% and your payment is $150 per month, then on your 10th year anniversary your balance will be zero, and you will stop making payments on the loan. 12. What is the difference between fixed and floating rate loans? A fixed rate loan means that your interest rate remains consistent, while floating rate loan changes with the market. The variable interest mortgage is a type of floating rate loan, but most variable interest loans are floating rate. Analyze this. With a fixed rate loan, one cannot expect to change the interest rate of the loan during the time that it is outstanding. A floating rate loan is one with an interest rate that changes with the market. If you borrow money over a fixed period of time and then enter into a floating rate loan, your outstanding balance will have increased in accordance with the changes in interest rates from when you received your initial fixed rate loan. 13. How much are credit cards usually? Credit cards typically charge a percentage of the amount charged to a cardholder. Analyze this. Depending on your card's terms, you may be charged an annual fee or an interest rate that varies from the average rates for other customers using your same type of card. 14. How many points are typically awarded by a rewards program? In some reward programs, a point is 1% of all spending made on any product or service. Others reward users with more frequent freebies than this. 1 point every time you use a debit card like a bank card, 1 point for every $100 spent, or 1 point for every $5 spent on a credit card. In some reward programs, a point is 1% of all spending made on any product or service. Others reward users with more frequent freebies than this. 1 point every time you use a debit card like a bank card, 1 point for every $100 spent, or 1 point for every $5 spent on a credit card. Thank you very much for watching.